Picture a homeowner whose house has gone up in value. In 2000, that equity could push his net worth above $1 million, making him an accredited investor who could write a $20,000 or $50,000 check to a local startup before a bank or venture fund would take the risk. Today, I want to use a new Journal of Financial Economics paper called Angels, Entrepreneurship and Employment Dynamics to discuss why fewer angel investors meant fewer startups. Most young companies need first dollars before they have revenue, collateral, or a polished track record. Fewer than 1 in 500 new companies raises venture capital, while bank lending often asks for assets or personal credit that founders do not have. That first check often comes from an individual investor willing to accept more uncertainty. The 2010 rule created a useful comparison because housing wealth differed across states, so it removed more potential angel investors in some places than in others. The researchers used the survey of income and program participation to estimate how many households lost accreditation when primary home equity stopped counting toward the $1 million standard. They matched that exposure with pitchbook evidence on angel financings and census measures from the Business Dynamics Statistics and quarterly workforce indicators. The rule reduced angel-backed companies and early-stage angel dollars, rather than merely changing a legal label. In states with the largest shock, new firm entry fell about 2% after 2010, with the sharpest damage among small entrants and young firms. Employment at firms with 10 or fewer employees weakened too. Some small and young incumbent firms hired more workers as competition eased and job destruction declined. In the real business world, startups rarely get every kind of funding at the same time. Angels often invest when revenue is thin, collateral is scarce, and founders are still testing whether an idea can become a business. A small check can pay for the first product, first hire, or early customer tests before larger investors see traction. Venture capital usually arrives later, while banks look for revenue, assets, or a repayment record. The strongest entry effects appeared in digital and innovation industries where venture capital was already active, suggesting formal capital does not automatically replace an angel who arrives first. After the rule change, startups relied more on friends, family, and other non-accredited investors reported through Form D filings. That shift only partly substitutes for angel finance because it moves risk toward personal networks and complicates governance. Survey evidence puts the middle half of angel investments at roughly $15,000 to $37,000. So, the number of people willing to write the first check may matter as much as total dollars. The rule also had an investor protection goal, since private investments can be hard to value, hard to sell, and easy for households to misunderstand. The evidence tracks startups and jobs affected by tighter access, while leaving open how many bad investments the rule prevented. That trade-off matters because the Securities and Exchange Commission revisits accreditation standards periodically. So, a small eligibility change can shape household access and business formation. Informal finance is part of the infrastructure behind entrepreneurship, even when its transactions remain mostly invisible. Fewer angel investors meant fewer new firms, weaker employment at the youngest entrants, and more room for some existing companies to hire after competition weakened. Who can write the first check helps determine which companies get started and where new jobs begin.